Was that a hawkish shift over at the Fed on the margin, a little one?
I mean, it was perfectly predictable given that the economy is doing quite well. I mean, they've been saying this is what they're going to be doing. They're going to gradually normalize monetary policy, and they're just justifying the fact that they're going to continue to do so. So I wasn't particularly blown away by anything in that statement.
The only thing that's gradually normalizing, though, is treasuries. Yields are grinding higher. It's a slow motion sell-off. I don't see this happening anywhere else. I see the Fed incrementally raising interest rates, but financial conditions are still really loose.
Oh, they're extremely loose. Look, the fact of the matter is the bond market has been rigged by central bankers for, almost 10 years now. They've been the big buyers of treasuries and mortgage-backed securities in the United States, and of course their own securities in the ECB and the BOJ. And the U.S. decided that back in 2014, October 2014, is that they had enough of QE. And over the past couple of months, they've actually tapered their balance sheet. So everything's been communicated very well, and I think the bond market just getting a little bit less rigged.
You coined the phrase bond vigilantes many, many years ago. Are the vigilantes dead? Are they ever coming back?
Well, they're sticking their head up from the grave like the movie Carrie a little bit. I think if you look at the bond market relative to nominal GDP, I call that the bond vigilante model. How are bonds trading relative to nominal GDP? Nominal GDP, right now, it's 4.4%, and the bond is 2.7%. And throughout this expansion, the bond yield is below the growth of nominal GDP. So it's actually been held down, I think, by the central banks. And now, if you, on that chart, put in, let's say, the German bond yield or the Japanese bond yield, still near zero, you can see you got nominal GDP 4.4, and you got zero here, and the bond vigilantes are crawling up a little bit.
Gina, we're starting to see the reprice in 10-year treasuries. What does that ultimately mean for the equity market? So long as it's this slow and this gradual, is there anything to fear?
Well, I think it depends on why it's rising, right? If it's rising because suddenly we're having this inflation breakout without a really strong acceleration in growth conditions, that could be very problematic for equities. Certainly that bond yields play through the equity market in a number of ways. The biggest way is through valuations. And rates rising generally creates some compression on valuations. But they also play through the earnings stream. And frankly, in an environment where the Fed is tightening rates, where rates are generally rising, market prices are driven by accelerating earnings. So we've got to see consistent acceleration in earnings. And if bond yields ultimately result in some sort of deceleration in earnings, or earnings don't keep up, then prices will likely falter.